Perhaps we won't see the long-awaited recession this year as businesses adjust. But as we start the second half of the year, this week investors are confronting a confusing economy and the likelihood of the Fed raising rates later this month. That's why a top investment officer thinks caution is required. A look at what's ahead for investors next on Quartz Smart Investing. Our guest today is Cameron Dawson, Chief Investment Officer at NewEdge Wealth. Nice having you with us, Cameron.
Thank you for having me.
So why the caution in a market that a lot of people are excited about, especially around technology?
So what we think is that there's probably too much caution on the economic outlook. That's where forecasts really do look too low. You effectively have economists forecasting a recession to start in the third quarter, which is where we are. But if you look at the data coming out of the economic data, what you see is that there's a lot of resilience. We're hanging in a heck of a lot better than most people expected. So we think that there's room to surprise to the upside on the economic front. But what we're also seeing is that there's already a lot of optimism priced into markets, whether we're looking at earnings, which are set to recover a lot later this year, as well as into 2024, and valuations, which are now at highs that we haven't seen since prior to the pandemic. So we're really stretched on the valuation front, and there's optimism in the earnings expectations.
You seem quite surprised that valuations don't reflect other trends going on in the markets. Why is that phenomena exist?
Well, we see it exist quite a bit in the short run. Valuations can diverge from fundamentals. We've seen it during different bubble periods, and there's times where valuations can go high and stay high. In fact, if we look at the correlation of valuations and how they predict one-year forward returns, it's actually not a great predictor. The prediction of valuations gets much stronger when you look out 2 and 3 years. So right now we're in an environment where valuations are very high, and yet interest rates are also very high, mostly real interest rates. Though that divergence typically does not last and persist. However, we are in this environment where there's strong momentum behind markets, which is what's driving us to such high valuations.
Tech stocks couldn't be higher, it seems, but yet there are many in your field who think there are still buying opportunities. What's your view?
Well, we are overweight tech in our portfolios because we do see that having the best trends, the best momentum in the market. But we're starting to get more cautious because valuations are very stretched. If you look at the tech sector overall, it's now trading at near the valuation highs that we saw during the pandemic. That's very significant because if we go back to that pandemic time, that's when the Fed was flooding the market with stimulus. You had deeply negative real interest rates. Money supply was growing 25%. You could justify tech trading at such high valuations. But today, that picture from a policy standpoint is the exact opposite. The Fed is still very much in tightening mode. Interest rates are high, money supply is shrinking, and so eventually we think the liquidity and the interest rate scenario will start to call into question some of these elevated valuations.
Can the economy and the big companies that make up a lot of it continue to avoid recession by doing what they're doing, as companies do in these periods?
Well, it certainly seems that way, and I think the reason we've avoided a recession is really coming from two main things. The first one is that the labor market still remains extraordinarily tight, and the way to think about it is that when consumers have jobs, they spend money, and what we've seen is that consumer demand has remained far more resilient than people were really expecting, given the fact that you have high inflation, which was kind of expected to pinch into consumers' ability to spend. The other aspect of things is that we don't think that higher interest rates, short interest rates, when the Fed raises that short interest rate, nearly bites as much as it did in the past. And the reason is we had nearly 15 years of quantitative easing that kept long interest rates low, that allowed consumers to borrow fixed mortgages at 30 years, or for corporations to borrow long-term at very low rates. The end result is when the Fed raises rates, there's not as much shock to the system as there used to be in the pre-quantitative easing world. So we think some of the impact of the Fed's policy has been dulled in this brave new world.
So let's talk about what this means for consumers. Again, you're prudent, it seems, across the board in terms of what you're suggesting for your customers. What should people who are watching this be doing vis-a-vis their portfolios?
We think that quality is the best strategy in this market environment and really for the long term for investors. What quality means is that you're looking for companies that have strong cash generation, really solid balance sheets. These are not names that are going to lead in the upcycle in the most go-go parts of the market, kind of like some of those speculative tech names that have been leading recently. Instead, quality is that slow and steady wins the race. These are names that tend to compound growth through cycles. They go down less than they went up in the prior upcycle. And when you see those quality names go on sale during periods of market turmoil, it's a fantastic opportunity to continue to add to positions. So we remain quality focused across our equity portfolios, so that way we can remain invested even in periods of market uncertainty.
And again, so much attention on tech, and in particular about AI. Do you think AI is a passing topic of conversation or a meaningful thing, say the internet in 1997?
One of the things about the internet in 1997 is that it came with a massive capex boom. You had to lay fiber optic cable. People had to buy modems and computers in order to get connected to the internet. What's less certain today is if there will be a massive capex boom outside of semiconductors and data centers, which we've already seen in the evidence of the earnings of companies like NVIDIA, if that will be broader in the rest of the economy. We think that there's still a great deal of uncertainty about the efficiency benefit of AI for the broad economy. We know certain companies will benefit from it a lot, but we're not yet in the place where we can really start putting it into earnings estimates and numbers as we look in the near term.
An interesting third and fourth quarter ahead, to be sure. Thank you, Cameron.
Most definitely.
For more of today's top business news, as well as timely analysis, stay with QZ.com.